What if I told you there's a government bond that's paying more than 7% interest rate? Is it true? Yes, it is. I've got details coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so we're all searching for yield. How can we combat this rising inflation, okay? The gap between interest rates and inflation, so real interest rates, it's the widest it's been since what, the 70s? They are keeping interest rates low while heating up inflation, and it's punishing savers. So where can you get yield? Savings account? No, it's paying nothing. What about the online money market, which is my favorite savings account, if you will? No, that's not keeping up either. 0.4, 0.5% is best you can get. Could you do a CD? No. Even pushing that thing out for years, you're still only going to get a couple percent, if that. A fixed account, maybe 2, 3%. Okay, let's go higher risk and do a corporate bond. No, 3%. There's nothing that's keeping up with inflation. What if I told you about a special savings bond issued by the U.S. Treasury called an I bond? And that's right, the I stands for inflation. This puppy is paying 7.12%. That's real. That's real. There's no catch. There is something you got to be aware of, but an actual bond that's keeping up with inflation, 7.12% issued by the Treasury. Let's check this thing out. So here's how this thing works. There's two interest rates that are baked into this thing, and there's a fixed rate, which is 0%, and it's been 0 for a long time. And then there's the inflation component, and that interest rate can change every 6 months. And right now, up until April, all bonds issued until April of 2022 is paying 7.12%. That's fantastic, right? That's the best interest rate you can find out there. And when you look at the risk, right, this isn't a high yield bond that carries a lot of risk to it. This is a treasury bond. It's a government bond, savings bond. So that's fantastic. These bonds pay interest every 6 months, and the interest is compounded. That's one drawback. It doesn't look like you can pay the interest out to yourself. So if you're wanting to collect this income right now, it doesn't look like these I savings bonds are the way to do it. But it pays out interest every 6 months, and that interest is immediately compounded, added to your principal. These are 30-year bonds, but it doesn't mean you're stuck into this thing. Your money's locked up for 30 years. How it works is, again, they reset the interest rate and they pay it every 6 months. But you can withdraw your money out of this thing after a year. If you withdraw your money or withdraw your cash out your account within 5 years, you lose 3 months of interest, okay? So if you held this thing for 18 months and you cash it in, you only actually get 15 months of interest, okay? But if you hold this thing for 60 months, for 5 years, and then you cash it in, you get to keep all your interest there. So, is this thing tax efficient? No, not really. No, not really. It's subject to federal taxes, not subject to state taxes, so not really tax efficient. Let's take a deeper look into that interest rate component. Take a look at the history here of how this thing, number one, calculates the interest rate. There's more details. The link is below in the description if you want to read all these geeky details as to how the interest rate is calculated and so on. But take a look at this, the history of the interest rates. It can go negative at times, guys. And so I wouldn't personally, they're not going to reset the inflation component of the interest rate until April of next year. A lot could happen in those next 4 months. My guess is this thing still won't be running at 7.12%. Oh, gosh, I hope not. I hope not. Maybe it'll come down to 6%. Maybe it'll be 5%, something like that. We'll have to see. They will adjust that interest rate, though, that you'll be receiving at that point. And then that's not just a unique thing that you would be receiving. That applies to all. So you don't lock in 7.12% for the next 30 years for as long as you want it. You only have that interest rate until they change it, which would be in April next year. So then what's the catch? What's the catch? The big catch to me is you can't put all your money into this thing. I was working with another one of our advisors, Brendan, on this, and we were exploring it for an individual that has about $500,000 that we're looking to get some yield from. And as Brendan and I were looking at it, he said, hey, there's a max purchase. And that's right. You can only put 10 grand into this thing, in per calendar year, okay? And that's if you're going through Treasury Direct and buying it online, which of course you would. If you wanted a paper copy, then your limit's only $5,000 a year that you can invest in this thing. Don't even worry about that. That's the catch. There's no other catch as in this big risk or you could lose all your money, something like that. I mean, the catch is that you can't lock in this interest rate for 30 years. It's going to change every 6 months. This one will change in April. But the other catch is you can't put all your money into it. There's a limit of 10 grand per calendar year. So is this something you should consider? I say yes. Talk to your CFP about it. Now, to weed out some of the most common use cases, this is not for an emergency fund. No, it's not. And we're all looking saying, well, I've got, 15 grand, 20 grand, 25 grand, 10 grand sitting there in an emergency fund, not keeping up with inflation. What do I do with it? Well, because you've got to, it takes a little bit of time to get access to this money and you give up some interest rate and it's locked up for 12 months, at least the first 12, it's not appropriate for an emergency fund. Can you assure me that you're not going to have an emergency in the next 12 months? No, you can't. You can't. I mean, you would have, in February 1 of 2020, you would have said, yeah, I'm not foreseeing any emergencies on the near horizon. And sure enough, the world looked very different 3 weeks later. So I don't think it's appropriate for an emergency fund. Now, if you've got an overfunded emergency fund and you want to start feathering in some dollars in there, maybe work with your CFP on that. Is this for Roth IRA contributions, IRA contributions? I would also argue no, okay? I wouldn't use it for tax shelters. I wouldn't put this in a tax sheltered strategy. So already it weeds out most use cases. And so therefore, for those of you above and beyond your emergency fund, for dollars that you have invested, you don't need in the near term, this could be a solution. Some of you have been asking the question, all right, I've got some money. It's not long-term money, but I don't need it in the short term either. I might need it in a year, 2 years, something like that. This could be a great option. This could be a great option. Work with your CFP on this. Is finally a solution to fighting inflation, keeping up with inflation with some low risk dollars. Talk to your CFP on that. If you don't have a CFP helping you with comprehensive financial planning, because if you don't, your CFP is not going to bring this up, right? Because this is not a tool, a product that they can help you get into. The only way to get access to it is through Treasury Direct. So you've got to have a CFP that's doing comprehensive financial planning, and they can help figure out if this is the right solution for you. So if you have someone like that on your team, fantastic. If you don't, contact one on my team. Find us online. Korhorn.com, that's Korhorn with a K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.